Hi there, Chris Oddy here of Marslands Accountants. And today's video, I'm actually following on from my previous interview meeting with Michelle. That was our last video. And following on from that rental video, we brought up payments on account. So when you're in the tax system and having to do tax returns each year, if your tax was to exceed £1,000 in a year, you may be required to make payments on account. Well, let's start off from the beginning. So if you have a tax bill of, let's say, £2,000 as an example, and unfortunately, if your 80% of the tax that you pay isn't coming through PAYE or bank interest that's being taxed at source, if there are any accounts that still do that, is essentially you will be required to make payments on account. What those are is you'll make a payment in January and you'll make a payment in July to go towards your next tax bill. So if we use this tax year at the moment, which we're currently doing, so the 2023-2024 tax year, if when we come to do your tax return, you have a £2,000 tax bill, what will happen is you'll get £2,000 to have to pay by the end of January, so the 31st of January, and then you'll also have another £1,000 which is due also by the 31st of January. Now, the reason that this is that HMRC essentially say when you have your over £1,000 tax to pay, that you have to start making payments on account to go towards your next tax bill in the next year. So because you've got £2,000 worth of tax to pay, you're required to make half of that payment again by the end of January to go towards your 2024-2025 tax return. So you'll make £1,000 there, so your total tax due by the 31st of January will be £3,000. And then what will happen is you have to pay the other £1,000, so the other 50%, by the 31st of July. So then once you've made that, and then when we come to prepare your tax return for 2024-2025, you'll have already made those £2,000 payments on account towards your tax return. So let's say your tax due for that year was £2,000 exactly. You'd have already paid off that tax. You would just have to pay off what your payment on account towards next year would be. And then that's how it kind of works. So obviously that first year that you go over that threshold is a tough year because of the fact that it's the first time you have to make those payments on accounts. You're essentially paying 1.5 times what your tax bill was. But obviously going forward, you'll then have that go against the next year and things like that. Some typical questions that we do get is something like, oh, but next year my profits are going to be lower. What's gonna happen with that? I don't want to have to pay this much on. It is possible to reduce the payments on account if there's reason to do so. But it's obviously really important to make sure that when you do that, it is done correctly. And always suggest your accountant does that for you, just because of the fact that if you reduce them too much and it ends up being that you should have paid more because that's what your tax return said you should have paid, then you'll also have interest paid for the late payment in tax because technically you should have paid it back in January and July the year before. But that's just something to consider. So why you would do reduce payments on account? So it could be anything. So it could be, let's say you had a rental property one year, but you sold it in the year. So next year you're not going to have it, or you don't want to have to pay your payments on account towards your rental if your rental income is going to be zero this year. Or it could be that you stopped trading if you're a self-employed client. It could be that you normally receive dividends, but in the year you've sold your dividends, so you don't have any going forward next year. So you won't have those. So there's lots of different reasons why you may reduce them. But as I say, it's always best to speak to your accountant before you make any decisions on doing things like that. As I say, the other reason that you wouldn't have them is if over 80% of your tax due that year had already been paid through sources. So the two main sources that you may pay tax on, it's unlikely with bank interest so much anymore, but there might still be accounts where you have to pay tax on your interest at source. But the most way is obviously through your employment. So let's say that you have a big job and you're paying a large sum of tax each year through it, and then you add your rental account on the side, which is only a one-bedroom flat somewhere and it's not making much of a profit. It is likely that with regards to that 80% of the tax is already going to have been paid if you're already earning over 100k through that. So that's why you wouldn't require payments on account. But for the general public, payments on account would be required because they wouldn't have paid over 80% of their tax through their PAYE code already. But that's really it for payments on account. It's a bit of a confusing subject and it's quite easy to explain once you have some figures in front of you. So if you need help with it and you want someone to help with your tax returns going forward, please contact us by visiting our website, which is www.marslands.co.uk. And we can go from there and find out more about your situation and give you a quote. But yeah, thank you for watching. Bye.